Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. Most of the time, my work entails identifying attractively valued stocks that I think people can invest in for long-term profit and gain. Valuation is such an important consideration when investing in stocks. However, in recent times, we find ourselves in what, for the most part, is a very overvalued market, so quality at value is very hard to find. Therefore, I thought it would be important for me to also do a little bit of work showing people what I think they should be avoiding as investors. And this is primarily a valuation-based concept. So what I'm going to do today is take a look at a company that I actually like and have liked and have actually followed for some time. However, recently, the greater fool theory has set in and people have driven this stock up to a ridiculous valuation. And the reason for it is because this company is one of the largest producers of lithium. And of course, lithium is what is being utilized in the electric cars like Tesla, etc. And so the demand for lithium has grown tremendously, but people often get caught up in hype and hysteria. And I'm going to show you just how irrational that can be by taking a close look at a stock called Albemarle. Now, of course, in order to do that, I'm going to utilize the Fast Graphs Fundamentals Analyzer software tool and show you what I like about this company. So I'm going to take a few things off of this chart, and I want you to see the company's earnings growth, which is this orange line, the dividend, which is this white line. And I want you to notice that earnings have grown at a rate of 12.6%. although there have been certain periods of cyclicality along the way. But it's really a good company. It only has 25% debt, a $13.6 billion market cap. Now next I'm going to add monthly closing stock prices, because a secondary lesson that I try to always show people is the earnings and price relationship. And I want you to notice how monthly closing stock prices have so closely tracked this company's earnings growth or operating results over time. Now stock prices are always volatile, and as a result they can always be irrational, or they can often be irrational. You see periods where the stock gets overvalued and then it reverts back to what I call the orange justified valuation line. The orange line in this graph is a valuation reference. When the price is touching that line, it's fairly valued. When it gets below the line, like it did during the Great Recession, it becomes undervalued. But that also applies to where the earnings go over time. So here's a time when the stock was actually technically fairly valued by my definition, but the company's earnings growth was very weak during this period of time, and the stock price of course followed that weakness. So we had literally virtually no growth, 2% growth, and the stock price actually went from $56 a share to $56 a share over this roughly 5-year period. There was really no return from a standpoint of capital appreciation. Now, I want you to notice that I've stopped this graph in 2015, so I'm looking at the historical results of this company, and I really want to point out that the price tracked that. But here we are under current times, and I do want you to notice a couple of things. Again, the company is a big producer of lithium, and as a result they are forecasting earnings growth. In fact, earnings growth the last couple of years have been reasonably attractive. I'll shorten the time frame a little bit so you can see that more clearly. But the price has gone straight up as a result, and the more the stock price went up, the more people chased the price. But the point of the story here is that this is unprecedented in this company's history. Normally, the price tracks the company's earnings. This is really a strong emotional reaction of greed because the lithium market is supposed to be so good, but this stock has nowhere to go but down from these levels. It's a really good company. It's probably going to grow actually quite nicely over the next several years thanks to the lithium market. However, even when you consider growth rates of 15 to 16% going forward, there is absolutely no way that it supports the current PE ratio. And if the stock were to trade at a more normal PE ratio, I'm going to put the normal multiple up here, which has been about 14, investors could lose 7% annualized. Over the next year or two, they could lose up to 40% of their money. So this is an interesting company, and it's involved in an industry that's going to be quite attractive, or a product at least that's going to be quite attractive going forward. But you don't want to be the greater fool and pay more than the stock is worth simply because other people are doing it. One of my favorite sayings is, and one that I personally coined, is that the problem with running with the herd is that your ultimate destination is the slaughterhouse. And I bring this stock up today because I want you to notice that there's been a break. I don't know if the music completely stopped, but the stock is down 7% today, and on really nothing that was really significant in terms of any any real news. Their earnings were not stellar, but they weren't horrible. But the point is, this is clearly a greater full stock. The price is way above what the earnings would justify. So not only is valuation important on the buy side, it's also important on the sell side. Great company, ridiculous valuation. And I do want to point one last thing out about saying that. The company really had nothing to do with this. This is people buying the stock and running the stock price up. This has been Chuck Arnold saying, first of all, thanks for watching, and I hope you got something out of this. Thanks again.